Welcome to Talk Tickers. Today, we are jumping right into a really wild quarter for Oracle. I mean, we saw what looked like a solid earnings beat get met with an absolutely brutal market sell-off. So we're going to explore why investors' short-term fears are completely trumping the company's long-term vision and what it all means for Oracle's massive, high-stakes bet on AI.
Okay, let's just start with the market's reaction, because it tells you almost everything you need to know. Despite what looked like a pretty good quarter, Oracle's stock just plummeted, down over 11% in after-hours trading. Now, this wasn't some minor dip, This was a huge, flashing red light from investors about the company's immediate future and the insane costs tied to it. And this is really the heart of the issue, right? It's a tale of two completely different stories. In one corner, you've got this great headline, earnings beat, and a mind-blowing AI order book. But in the other corner, you have a miss on revenue and this terrifying, soaring cost to build out that AI future. So let's dig into why everyone seemed to focus on the bad news.
All right, Section 1, a beat, a miss, and a shock. Let's get into the headline numbers that caused all this confusion and volatility.
So if you just glanced at the headlines, you'd think things were great. I mean, non-GAAP EPS came in at $1.34. That's ahead of the street's consensus estimate of $1.33. A beat is a beat, right? Normally, the market would love that, but that is definitely not what happened here.
And here's the catch. The quality of that beat got called into question almost immediately. Why? Because a big chunk of it came from a one-time gain on their investment in a chip designer called Ampere. And investors, well, they tend to look right through those kinds of one-offs. They want to see growth from the core business, not financial engineering.
Okay, so if you look past that one-time gain, the rest of the story, well, it wasn't quite as rosy. Total revenue actually missed what Wall Street was looking for, even if it was just by a little bit. And their cloud infrastructure, their IaaS business, yet grew 49%, which sounds awesome, but the street was hoping for even more, something over 50%. The point is, the core growth just wasn't strong enough to make people forget about that low-quality earnings beat.
And this really gets us to the main event, the incredible, massive promise of Oracle's AI future versus the absolutely brutal reality of what it's going to cost to get there.
So management drops this number, and it's a jaw-dropper. $65 billion in what they call remaining performance obligations. Basically, that's their backlog of contracted future business. It is just stuffed with huge AI deals from all the big names. OpenAI, Meta, Nvidia, you name it. The demand is clearly there.
In this quote from Larry Ellison, this is the whole game plan right here. He's saying, look, training AI on public data, that was big. But the real money, the next massive business, is getting AI to work with private company data. And that's where Oracle thinks they have the ultimate ace up their sleeve, thanks to their huge database business.
Okay, but that amazing vision, it comes with a price tag. And wow, what a price tag. Capital expenditures, or capex, for this fiscal year is now forecasted at $8.5 billion. That is an immense amount of cash they're about to burn through to build out all these data centers and buy all that specialized AI hardware. So how are they paying for all this? Well, they're borrowing. A lot. All this historic spending has pushed their total long-term debt to around $90 billion. And you better believe that number is raising some serious red flags on Wall Street about the health of their balance sheet.
Which brings us to the big question, right? How does a $65 billion backlog lead to the stock getting absolutely crushed? Well, the answer is simple. The market cares way more about today than it does about tomorrow.
So why did everyone hit the sell button? Let's tick through the 4 big fears that were driving this. It's really a classic case of jam tomorrow just not being good enough for investors today.
So here's what's really on investors' minds. 1, all that capex means massive cash burn and a ton of debt. 2, that EPS beat we talked about, they see it as low quality because of the one-time gain. 3, their guidance for next quarter was, well, pretty weak. And 4, and this is the big one, management basically admitted the real revenue payoff from all this AI stuff won't even show up until fiscal 25. In this market, that feels like an eternity away.
Okay, so with all that as the backdrop, let's get to our final segment. The next call. Here's our take on where Oracle stock is headed from here.
We're putting an underperform rating on Oracle shares. Look, the long-term AI vision, it's incredible, no doubt about it. But the short-term pain, the massive spending, the rising debt, it's just too much of a headwind to ignore right now.
So our thinking here is pretty straightforward. The market is going to keep punishing this stock because of the near-term cash burn and the pressure on their margins. Execution is everything now. They have to prove they can turn that giant backlog into actual profitable revenue. Until they do, we think the stock could actually get cheaper as the market adjusts to this new reality of high debt and massive spending.
So what's a potential trade here? One idea is to look at long-dated put options. And to be clear, this isn't a bet that Oracle is going to go bust, not at all. It's more of a way to hedge against or protect against all the volatility we expect to see. If there are any delays in this huge build-out through fiscal 25, the stock could easily take another big hit.
And of course, we always have to say it, this is not financial advice. Our analysis is purely for informational purposes. You absolutely have to do your own homework and consult with a financial professional before making any investment decisions. Thanks for tuning in.